Welcome to The Explainer. If you've ever stared at a spreadsheet and felt a little bit of panic or been overwhelmed by financial jargon, you are in exactly the right place. Today, we're completely demystifying accounting. We're going to strip away all that complex terminology and look at it not as a bunch of abstract math, but as a totally logical step-by-step process. And to make this really practical, we're going to follow the entire journey of a transaction using a simple real-world example and neighborhood coffee cart business. Right off the bat, here's the golden question for absolutely any entrepreneur. Imagine you're running this coffee cart. You see cash coming in from customers all day, but you're also constantly buying beans, paying for city permits, fixing broken equipment. How do you know if your business is actually making money, or if you're just incredibly busy? Well, accounting is the ultimate system designed to answer that exact question with absolute clarity. To figure that out, we're following a 6-step roadmap today. What is accounting, the forming objectives, and then the 4 major phases of a transaction: identify and measure, record and classify, summarize and analyze, and finally, communicate. Let's dive in.
So section 1, what is accounting, really? We hear the word constantly, but let's see how the experts actually define it.
The American Accounting Association actually keeps it surprisingly simple. They define it as the process of identifying, measuring, and communicating economic information to permit informed judgments. So at its absolute core, accounting isn't just hoarding a bunch of data. No, it's an information system built specifically for decision makers. It literally turns raw daily chaos into actionable intelligence.
Now compare that to the American Institute of Certified Public Accountants. Look at the very first word they use: art. I love that. While accounting absolutely relies on highly structured math, deciding exactly how to categorize complex events to reflect reality, well, that requires real skillful practice and judgment. It truly is an art form. Moving right along to section 2, the 4 main objectives. This is the why behind all that structured art. Our sources outline 4 main goals here. First up, keeping systematic records. Think back to our coffee cart. You need a solid, orderly way to track daily espresso sales and those giant boxes of paper cups. Second, ascertaining profit or loss. Basically, did the cart actually make money this month? Third is your financial position. You need to know exactly what the business owns, like that fancy espresso machine, and what it owes, like maybe a bank loan. And finally, providing all this info to interested parties so they can make rational decisions. All right, let's jump straight into the 6-step journey. Identify and measure, record, classify, summarize, analyze, and communicate. This sequence perfectly maps out the entire scope and function of accounting into one beautiful chronological flow. Literally every single transaction your business makes is going to travel down this exact path. Which brings us to section 3, step 1 of the process: identify and measure. These are the very first actions you take when a business event happens. So identifying simply means recognizing the financial transactions that actually change the resources or wealth position of your business. Because look, not everything that happens in a business is an accounting event. Say you hire a new barista for the cart. Huge event for sure, but it's not a financial transaction yet. But if you buy a massive wholesale order of coffee beans, that changes your wealth position. You've got less cash, but more inventory. And crucially, you have proof. You've got the invoice or receipt from your supplier to back it up. And once you've identified that event, you have to measure it. In the accounting world, measuring just means expressing the transaction in monetary terms. You wouldn't record that you bought 3 bags of medium roast. You'd record that you spent exactly $50. Money is the universal language here. It lets us compare apples to apples or, coffee beans to paper cups. Next up is section 4. Step 2, record and classify. This is the critical phase where we take those measured receipts and actually get them into the books. This is a really important distinction. You've got to notice the difference between the journal and the ledger. Recording happens in the journal. Think of the journal as your book of original entry. It's the raw, chronological diary of your coffee cart's day. Like at 8 a.m. you bought milk, 8:15 you sold a latte, 9 a.m. you paid a permit fee. But ma'am, that diary gets really hard to read if you just want to know your total milk costs for the entire month. That is exactly where classifying comes in. The ledger is where you take all those daily milk purchases and group them together into one specific milk expense file. Make sense, right? So once everything is grouped into those neat categories, we hit section 5, step 3, summarize and analyze. This is where we condense that huge mountain of classified data to see the big picture.
The summarizing function basically gives us three key documents. First, the trial balance, which just checks our math. Then we've got the profit and loss account or income statement, which summarizes our incomes and expenses. And finally, the balance sheet or position statement. I love breaking down this jargon because it sounds incredibly complicated, but the balance sheet simply shows exactly where your business stands at a very specific moment in time. What's its capital? What does it own as assets? And what does it owe as liabilities? And once all that data is summarized, we hit the analyzing phase. By comparing our summarized income, like all those total coffee sales, against our summarized expenses, the beans, the cups, the permits, we ascertain our net profit. This right here is the absolute moment of truth. Did the coffee cart actually generate a profit or take a loss?
Which brings us to our final section and the very last destination of this transaction journey: communicate. Communicating simply means distributing these analyzed reports to the interested parties who really need them. For example, management needs this data to frame future policies, like, hey, does the cart make enough profit to open a second location? Banks and creditors need it to evaluate your financial health before they even think about approving an equipment loan. And of course, tax authorities need it for rational decision-making and compliance. The whole accounting loop isn't fully closed until this information is actually delivered.
So as we wrap up this explainer, I want to leave you with one big question. Now that you understand accounting isn't just arbitrary math, but a deliberate, logical journey of identifying, recording, summarizing, and communicating, ask yourself, what story are your numbers telling? Because by following these structured steps, you aren't just doing bookkeeping. You're literally revealing the true underlying narrative of your business. Thanks for joining me today, and definitely keep looking closely at what your data is trying to teach you.